On Thursday, the Monetary Board of the Central Bank of Sri Lanka decided to maintain policy interest rates, which meant the standing deposit and lending facility rates are unchanged at 14.5% and 15.5% respectively. Let's look at why the Monetary Board took this decision. In a statement, the central bank noted that the board had considered the latest macroeconomic conditions, the expected developments and macroeconomic projections, prevailing tight monetary conditions, decelerating pace of inflation, as well as the envisaged disinflation path in the near term, supported by domestic and global factors. Let's look at each of these in more detail. Domestic economic activity is expected to remain subdued in 2022, before recovering in 2023. GDP contracted 8.4% in the second quarter of 2022, and is estimated to decline 8.8% for the full year. The second half of 2022 is to be weighed down by tighter monetary and fiscal conditions, continuation of supply-side constraints, uncertainty surrounding the business environment amidst shortages of foreign exchange. Recovery in 2023 is envisaged from improvements in the supply side, along with the timely implementation of the required reforms. In August 2022, outstanding credit extended to the private sector by commercial banks contracted for the third consecutive month. The board notes this is due to high interest rates, tight liquidity conditions, moderation of economic activity, and curtailing of non-urgent imports. The board also said the current declining trend credit growth would continue for the remainder of the year. Meanwhile, relatively high deposit interest rates are bringing in currency back into the banking system. Headline inflation, based on the Colombo Consumer Price Index, increased in September to 69.8%, with food inflation rising to a staggering 94.9%. Headline inflation is expected to follow a disinflationary path in the near term, whereas inflation is to reduce in the medium term as a result of subdued demand pressures from tight monetary and fiscal conditions, improvements in domestic supply, normalization in global food and other commodity prices, and the timely pass-through of such reductions to domestic prices, along with a favorable statistical base effect. The board noted that positive developments are observed in the external sector, despite heightened challenges. The trade deficit is contracting due to curtailing imports and increase in exports, whilst workers' remittances are improving, and a recovery in the tourism sector in the upcoming season is anticipated. As a result, foreign exchange liquidity has improved, facilitating the continuous purchase of essential imports in the periods ahead. Subsequent to the staff-level agreement reached with the IMF in September, Sri Lanka is expediting negotiations with its external creditors to advance the debt restructuring process. In conclusion, the board views that the current tight fiscal and monetary policy measures helps to curtail a further build-up of demand pressure. However, noted that the central bank will continue to monitor domestic and global macroeconomic conditions and take measures swiftly and proactively as appropriate. Finally, the board reiterated its commitment to restoring price stability while supporting the economy to reach its potential over the medium term. That's all from us for now. We will continue to keep you updated on further developments.